Hey fellow dividend investors, welcome back to the channel. Today we're doing a proper Singapore blue chip deep dive. If you've been around the Singapore market long enough, this Singapore blue chip has probably tested your patience more than once. For years it felt like the definition of dead money. The business was big, the brand was strong, the dividend used to be reliable, but the share price kept going down for a long time. And investors gradually lost faith that it could translate its scale into consistent shareholder returns. Then the script flipped. Over the past year, its share price surged, and it even hit its highest level in years after its FY 2025 results and capital return announcements. It later pulled back from that peak. This Singapore behemoth is of course Singtel. After such a big re-rating, the natural questions income investors are asking right now are, is Singtel still investable today? Or has the market already priced in all the good news? Does the recent pullback reflect an opportunity for investors who missed the upturn? In this video, we'll start with what changed, and why the market suddenly became optimistic again. Then we'll go through Singtel's main profit engines. We'll look at the dividend framework and capital returns. And finally, we'll talk valuation and risks, including whether I'm personally looking to add more to my portfolio. Before we start, a reminder that this video is for informational purposes only and not financial advice. Always do your own research and consult a licensed advisor before making any investment decisions. I own some of the shares discussed, but remember, what works for me might not work for you. Alright, let's jump right in. The turning point. Why Singtel was dead money, then suddenly wasn't. The simple reason Singtel struggled for so long is that investors stopped believing in the conversion story. Singtel owns valuable assets, it has large-scale operations, and it has meaningful stakes in regional telcos. But for many years, the market viewed Singtel as a group where value existed, yet wasn't reliably converted into higher per-share earnings, higher dividends, or better shareholder returns. And once that trust breaks, you get a persistent valuation discount. So what changed? The turning point wasn't just earnings improved. The turning point was Singtel formally repositioning itself as a disciplined capital allocator, not just a telco operator. And that pivot crystallized under a plan called Singtel 28, launched in May 2024. This matters because strategies only move the share price when investors believe they change the profit and cash flow trajectory. And with Singtel 28, the market finally saw a framework that could plausibly lift profits per share and dividends, even if top-line growth remains modest. Singtel 28, the plan that changed the profit story. If there's one reason Singtel's share price finally turned after years of stagnation, it's Singtel 28. The timing matters. The plan was announced in May 2024, and after that, investor sentiment towards Singtel began to shift. That wasn't because Singtel suddenly became a high-growth company, but because management laid out a clearer roadmap for how Singtel intends to grow profits per share and deliver shareholder returns, rather than just running a big telecom empire. Before Singtel 28, Singtel's strategy was largely about scale. It operated a large telco group across markets, owned valuable assets, and invested across associates. But scale didn't translate into consistent per-share outcomes. Capital went in, yet investors often struggled to see how it came back out as better shareholder returns. Singtel 28 marked a more explicit break from that approach. Under the plan, Singtel effectively reorganized around three drivers. First, core connectivity businesses like Singtel Singapore and Optus are meant to be stable and cash generative, reducing earnings volatility. Second, profit growth is meant to come from scaling higher quality engines like NCS and digital infrastructure under Eng's era. Third, and most importantly for valuation, Singtel made capital recycling and shareholder returns a formal pillar, setting a mid-term asset recycling target and explicitly linking realized value to dividends and buybacks. This is why Singtel 28 coincided with the market re-rating. It reduced uncertainty around how profits are generated, how capital is used, and how shareholders are rewarded. Now, the big question is, has the company delivered enough evidence to justify the re-rating? So let's test Singtel 28 against reality. FY 2025 and H1 FY 2026, the numbers that supported the re-rating. The first major proof point came from FY 2025 results. For the year ended March 31, 2025, Singtel reported net profit of 4.02 billion Singapore dollars, but the more meaningful number for ongoing value is underlying net profit, which rose 9% to 2.47 billion Singapore dollars. Underlying profit is important because Singtel explicitly uses it as the basis for its core dividend. FY 2025 also included a net exceptional gain driven in part by the partial divestment of Comcentre, which contributed to the jump in headline net profit. You don't value Singtel purely on one-off gains, but you also shouldn't ignore them, because under Singtel 28, value realization is part of the playbook. Then H1 FY 2026 reinforced the story. For the half-year ended September 30, 2025, Singtel delivered a 14% increase in underlying net profit to 1.35 billion Singapore dollars, while net profit was 3.40 billion Singapore dollars. This wasn't just good optics. It showed that earnings improvement wasn't a one-year fluke. And importantly for dividend investors, Singtel declared an interim dividend of 8.2 cents per share, consisting of 6.4 cents core dividend and 1.8 cents value realization dividend. That dividend structure is not cosmetic, it signals how Singtel now thinks about shareholder returns. Dividends. Core dividend versus value realization dividend. For dividend-focused investors, understanding Singtel's dividend structure is important. It is best understood as two layers. The first layer is the core dividend, supported by underlying profit and operating cash generation. The second layer is the value realization dividend or VRD, designed to share part of the proceeds from capital recycling with shareholders. This framework is explicitly described in Singtel 28 materials, which introduced a value realization dividend range alongside enhancements to the core dividend payout approach. For long-term investors, this structure matters because it changes the type of Singtel you're buying. Old Singtel was valued as a slow-growing telco with a single dividend stream that could come under pressure when conditions turned. New Singtel is increasingly positioned as a stable cash generator plus a capital management engine, where part of shareholder returns can be boosted by asset monetization and buybacks. Of course, this also means you should not treat VRD as a guaranteed annuity. VRD depends on the repeatability of value realization and the quality of reinvestment decisions, which takes us to the capital management engine. Capital management, the buyback and the raised asset recycling target. In May 2025, Singtel announced something it had never done before at this scale, a 2 billion Singapore dollars value realization share buyback program, expected to run until FY 2028, with shares bought back and cancelled, improving per-share metrics. At the same time, Singtel raised its mid-term asset recycling target from 6 billion Singapore dollars to 9 billion Singapore dollars. This is a big deal for valuation. A mature company doesn't need explosive growth to deliver strong shareholder returns if it can do three things well: generate steady cash flow, unlock value from assets, and reduce share count or return cash at scale. This is exactly the mechanism Singtel is trying to build. But capital management only deserves a re-rating if the underlying businesses are strong enough to support it. Before we go into the individual business engines and really stress test this Singtel thesis, if you're finding this deep dive useful so far, do give the video a like. It really helps the algorithm push such analysis to more investors. And if you're not subscribed yet, consider subscribing so you won't miss future deep dives on Singapore blue chips and income stocks that don't always make the headlines. Alright, let's get into the engine room and see whether Singtel is actually delivering on this new strategy. Singtel Singapore, the cash anchor. Under Singtel 28, Singtel Singapore isn't expected to be a growth engine. Its job is to be stable, resilient, and cash generative enough to anchor dividends. So the question isn't whether Singtel Singapore can grow quickly. The question is whether it has become predictable again, and whether it can reliably generate operating cash flow in a competitive, mature market. This is where investors should appreciate the quiet progress. Stability matters because it reduces reliance on volatile factors like associate dividends or one-off gains. And for Singtel, boring but reliable in the domestic business is one of the key building blocks that supports the core dividend framework. Optus, the biggest swing factor, and the biggest tail risk. If Singtel 28 is the blueprint, Optus is the execution test. Optus is massive within the group, and therefore it is both Singtel's strength and its headache. When Optus performs, Singtel looks like a disciplined cash compounding story. When Optus trips, Singtel gets dragged into political and regulatory headlines. And in recent years, Optus has tripped more than once. On the governance and conduct front, Australia's federal court ordered Optus to pay a $100 million Australian dollars penalty for unconscionable conduct involving disadvantaged consumers, following ACCC action. That kind of event doesn't just cost money, it can shape how regulators and the public view the company for years. On the operational resilience front, Optus has faced major outage scrutiny, including the national outage of November 8, 2023, which triggered an official review with a final report published in April 2024. And then in September 2025, Optus suffered a serious 000 emergency call disruption related to technical failure during a network change, which triggered investigations and public scrutiny, including an ACMA investigation into compliance with emergency call regulations. Now, here's the key investment point. Even if Optus operating earnings improve, repeated incidents can still create a valuation cap through higher compliance costs, tougher regulatory oversight, reputational damage, and weaker customer trust. Optus can be profitable and still be lower multiple if the market considers it operationally fragile. So for Singtel investors, Optus is the swing factor. If it stabilizes operationally and rebuilds trust, Singtel's cash flow story strengthens. If it continues to generate crisis headlines, Singtel's re-rating may stall regardless of other progress. This is why any Singtel thesis today must keep Optus in the foreground, not in the footnotes. NCS, is this a real growth engine? Under Singtel 28, NCS is explicitly elevated as a key growth engine. This matters because NCS is structurally different from telco. Enterprise and public sector digital services can deliver more scalable earnings growth than mature connectivity, and they tend to be valued more like an IT services business rather than a telecom utility. But the investor question isn't whether digitalization is a good theme. The question is whether NCS can consistently deliver earnings growth and higher quality profits that actually change the group's earnings mix over time. Singtel 28's re-rating assumes that Singtel is not just relying on legacy connectivity for its future. NCS is one of the core reasons investors can buy that story with a straight face. Ngxira and data centers, the valuation unlock question. One of the most important and most misunderstood parts of Singtel 28 is how Singtel treats its digital infrastructure under Ngxira, especially data centers. Before, data center assets could sit inside a telco group and get valued like a utility. Under Singtel 28, Singtel is treating data centers more like a monetizable platform, capable of partnerships, joint ventures, and value realization at valuations that can be very different from legacy telco assets. For Singtel investors, the key issue here is not whether data center demand exists. Demand is the easy part. The real question is whether Singtel can scale Ngxira in a way that improves returns on capital and supports per-share compounding, without simply becoming a capital-hungry builder of infrastructure. If Ngxira delivers, it helps justify a higher valuation multiple because it lifts the quality and growth profile of Singtel's earnings. If it doesn't, the market may treat it as expensive capex with uncertain payoff. Regional associates, smart recycling or shrinking the empire? Singtel's associates are valuable, but they are also where Singtel's capital recycling story becomes very real. Singtel has progressively reduced its stake in Bharti Airtel, unlocking significant proceeds as part of its asset recycling program. For example, Reuters reported a sale of a 0.8% stake in Airtel in November 2025 for about 1.5 billion Singapore dollars, and noted that Singtel's stake had reduced over time. The market generally likes these moves because they convert paper value into cash that can fund dividends, buybacks, and reinvestment into growth platforms. But there is a real trade-off. Selling down a high-quality associate reduces long-term exposure to its upside. So the question investors must ask is not, is asset recycling good? The question is Singtel recycling capital into higher return uses than the assets being sold? If proceeds are deployed into higher return Ngxira growth, NCS scaling, and buybacks that improve per-share outcomes, then recycling can enhance compounding. If proceeds are deployed poorly, then the company is simply shrinking future optionality for near-term optics. So far, the market is giving Singtel credit for improving capital discipline, especially because the buyback and VRD mechanisms create a clearer line of sight between value realization and shareholder returns. So is Singtel still attractive after the big run? Now we arrive at the hard part, Valuation and expectations. After a strong re-rating, Singtel is no longer a maximum pessimism bargain. The easy money was made when nobody believed the story. From here, returns are likely to come from three sources. First, dividends, especially the sustainability of the core dividend, and the repeatability of VRD. Second, modest growth in underlying earnings as the quality of the profit mix improves through NCS and Angzira, and as Optus stabilizes. Third, per share enhancement through buybacks and disciplined capital allocation. This is a very different return profile from the old Singtel, where investors simply hoped the share price would eventually wake up. The key risk, and the key reason I would not treat Singtel as a no-brainer at any price, is that the re-rating assumes better execution, especially at Optus. And Optus still carries outsized tail risk through operational resilience, governance, and regulatory scrutiny. The dividend uncle's take. So where do I personally land? If you already own Singtel from lower prices like I do, I think the thesis is still broadly intact. Singtel has made its strategy clearer, delivered improved underlying profits, formalized shareholder return mechanisms, and backed that up with a large buyback program and an expanded asset recycling target. If you are considering a fresh entry today, I would frame Singtel less as a deep value bargain and more as an improving quality compounder where entry price still matters. Personally, I would be comfortable viewing Singtel as a hold or a selective accumulation on weakness rather than an aggressive chase after a strong re-rating, because the market is no longer pricing Singtel as dead money. It is now pricing Singtel as a company that can execute a capital management and earnings quality upgrade. And the single thing I would keep watching like a hawk is Optus. If Optus proves sustained operational stability and restores trust, Singtel can continue to compound credibly. If Optus continues to generate crisis headlines and penalties, Singtel's valuation will likely remain capped even if other parts of the group improve. If you found this deep dive helpful, do give the video a like and subscribe. A surprising number of viewers watch but aren't subscribed, and you might miss the next flagship deep dive when we look at another Singapore blue chip that's quietly changing. Let me know in the comments, are you holding Singtel, buying at these levels, or waiting for a better entry? Thanks for watching, and I'll see you in the next video.